Welcome back. You know, the whole world is buzzing about artificial intelligence, and the stock market, it has gone into an absolute frenzy. But underneath all that hype, there's a much more grounded story. A story of silicon, power grids, and cold, hard, physical assets. Today, we're going to separate that digital dream from the physical reality.
So this is it, the trillion-dollar question on everyone's mind. Are we looking at the beginning of a massive productivity boom that's going to change everything and totally justifies these sky-high prices? Or are we just riding an extreme bubble that's getting ready to pop? You know, the experts are really split on this, and figuring out why is going to be the key to navigating what happens next.
All right, so to really get to the bottom of this, here's how we're going to break it down. First, we're going to tackle that bubble debate head on. Then, we'll get ourselves an investor's toolkit to help see through all the noise. After that, we're getting grounded in the physical reality of AI. We'll apply our new tools in a chip wars case study. And finally, we'll take a look at what's coming up over the horizon.
Okay, first things first. We have to talk about the elephant in the room, which is just the incredible scale of this investment frenzy. I mean, we're talking about company valuations that have just launched into the stratosphere. It's leaving even the most seasoned market watchers kind of breathless and wondering if we've all lost touch with reality here.
And you know what? This one number pretty much says it all, 175. At its peak, NVIDIA's stock was trading at 175 times its annual earnings. Now, to give you some perspective, the average company in the S&P 500 trades for maybe 24 times its earnings. So this isn't just optimism, right? This is a massive bet on a future that looks completely different from today.
In this slide, it just perfectly captures the two sides of the coin. In one corner, you've got a really respected asset manager like GMO, and they're calling this an extreme bubble that's just waiting to burst. But in the other corner, you have the giants, BlackRock and Vanguard, and they're arguing, no. This massive spending is what it takes to build a real productivity revolution. So who's right?
Well, that's the big question we're here to dig into.
So if we're going to cut through all the noise, we need the right tools. We're going to build a really simple but powerful investor's toolkit. And this is going to help us look right past those hype-filled headlines and start to separate the price of a stock from the actual value of the business behind it.
First up is the price-to-earnings ratio, or PE. Honestly, you can just think of it as a hype meter. It tells you how many dollars investors are willing to pay right now for just $1 of a company's current profits. Like we saw with NVIDIA, a super high PE doesn't mean a company's bad, not at all. It just means the expectations for its future growth are through the roof.
Next in our toolkit, we've got price-to-book value, or PB. And this one is a fantastic reality check. What it does is it strips away all the promises about the future, and it just compares the stock price to the real, tangible value of a company's assets. You know, its factories, its equipment, its inventory. A PB ratio that's close to 1 suggests you're basically buying the company for what all its physical stuff is actually worth.
And this brings up a crucial point, understanding risk. Look at a company like Procter & Gamble making Charmin toilet paper. It has a super low risk of becoming obsolete. I mean, let's be honest, we've pretty much perfected toilet paper. But then you take a tech company like Sirius Satellite Radio. It faces a constant threat from newer, better technologies popping up all the time. The point is, not all businesses are built to last in the same way.
All right, time for a major pivot. We're going to leave the abstract world of financial ratios behind and actually get our hands dirty with the physical reality that AI is built on. You know, it's so easy to think of AI as this thing that just exists in the cloud, like software, but that couldn't be farther from the truth.
This quote right here gets to the very heart of it. The AI revolution isn't just happening in the cloud. It's happening inside massive, incredibly power-hungry data centers. It requires this enormous physical build-out of hardware, infrastructure, and energy. It's a business of atoms, not just bits and bytes. And as we've seen throughout history, right, during a gold rush, the most reliable way to make a fortune is by selling the picks and shovels. Well, in the AI gold rush, the picks and shovels are the companies providing the essential hardware. We're talking about really advanced cooling systems from companies like Vertiv, because these AI chips run incredibly hot. We're talking high-speed networking from Arista to move these giant amounts of data. And of course, the massive power infrastructure just to keep the lights on.
All right, we've got our toolkit. Let's put it to work. We are diving straight into the epicenter of the AI boom, the semiconductor industry. This is where that digital world and the physical world collide, and it's where the battle for AI supremacy is being fought, literally chip by chip.
And wow, this table is just so revealing. Take a look at those price-to-book values. The market values NVIDIA at a mind-boggling 47 times the worth of its physical assets. Then you've got AMD, much lower at 4.6. And then there's Intel,
trading at just 1.1 times its book value.
I mean, just let that sink in for a second. While the market is valuing NVIDIA at 47 times its physical stuff, Intel is trading so close to its book value that it's almost like a fire sale. It basically implies that if Intel were to sell off all its factories and equipment tomorrow, shareholders would get back pretty much exactly what they paid for their stock today. It's a classic value play sitting right next to a historic growth story, and it's all driven by NVIDIA's almost total dominance of the AI market versus Intel's really expensive and slow attempt to catch up.
So where do we go from here? Well, the first wave of the AI boom was this mad dash for GPUs, the brains of the whole operation. But the next wave, it's probably not going to be about who has the absolute smartest chip. It's going to be about who can solve the very real, very physical bottlenecks that all this explosive growth has created.
And these are the three biggest hurdles right now. First, power. These AI data centers are creating gigawatt-scale demand that is pushing our electrical grids to their absolute breaking point. Second, specialized parts like high-bandwidth memory, which is basically just super-fast memory that gets stacked right next to the processor to keep feeding it data. And third, the advanced packaging you need to physically connect all these powerful chips together into one giant supercomputer. These are the new bottlenecks, which of course means they're also the new opportunities.
So here it is, the key takeaway from all this. The center of value might actually be shifting. While all the AI model creators are grabbing the headlines, the really durable, long-term value could end up with the enablers, the companies that provide the non-negotiable, absolutely indispensable physical stuff that the entire AI ecosystem needs to run.
So, the next time you hear about some revolutionary new AI model, here's a final thought to leave you with. Are you going to chase the brilliant lines of code, or are you going to look for the company that's pouring the concrete and laying the power lines that make it all possible? In this new digital gold rush, the most enduring fortunes might just be built on a foundation of atoms.